and in keeping with my attempts to debunk the myths and end the bull that surrounds the trading industry, today we're going to have a look a little bit more at technical analysis. The information in this presentation will be taken again from my first book, Technical Analysis and the Active Trader, and I'd like to point out at this point that there is over 2 years of research in that book, and in this presentation I can only capture a fraction of what's in there. So this is only going to give you a flavor of the sort of analysis and studies that I've found into technical analysis. So if you'd like to comment, and by all means I welcome comments, please read the book first so you can get all the full story rather than just a flavor that I'm going to talk about in this presentation. So the issues that we're going to cover here are about technical analysis. We're told that technical analysis measures market psychology, so we'll investigate that. We're told we can apply it to any market in the same way, we'll investigate that. And we're told it's successful. So psychology, I've mentioned before in the presentation, should traders use chart patterns, that if we don't believe that chart patterns measure psychology, then we shouldn't use them. And the same goes for any form of technical analysis. If we believe that they're just created by chance because that's how we present data, then we shouldn't use them. In that presentation, should traders use chart pattern, I showed, and I hope I proved, that chart patterns cannot measure market psychology. A failed pattern and a successful pattern can look exactly the same right up to the last moment. So the psychology supposedly behind the creation of the pattern cannot be the reason why it's successful or fails. It's just a pattern that is created by data. Also, when I was writing that first book, receiving lots of technical analysis by various analysts around the world, and what I noticed was they routinely used the technical analysis terms such as trends and bottoms forming and all these kind of technical analysis terms, but they applied it to economic data. For example, the unemployment rate, CPI. These are not traded. They don't involve human psychology buying and selling a product. So again, I'd ask technical analysts, if you're studying market psychology, why do you use them on data that has no market input, no buying and selling? I believe it's more likely that chart patterns, trends, the indicators that technical analysts use are a form of shortcut to help people analyze data. This type of shortcut has been observed by behavioral finance and is called representativeness. It is a shortcut to make decisions, but it doesn't make the decisions better. Also, with technical analysis, we're given similar or mirror tools to be used on rising and falling markets. For example, support resistance levels have the same philosophy. Support levels obviously are supposedly there when the market falls, resistance levels when it's rising. Head and shoulders and other patterns have tops and bottoms. So we're told that there's no difference in a market psychology between falling and rising markets. They produce the same psychology, we're told. But I would disagree strongly, particularly for equities and bonds. If we look at most participants in those markets, they trade for the long side. They're buyers of bonds or equities. Therefore, falling prices will hurt them, and rising prices will help them. We know from studies and just from our experience that people react very differently when they're facing losses to profits. Therefore, I think the idea that people make similar decisions when markets are rising and falling that create the same type of support and resistance levels and similar patterns is not true. Sure, on a chart these will look the same, they will form those patterns, they will form these points, but that is a coincidence that is bound to happen when we use charts. Charts of rainfall will have these patterns, but there's no psychology behind it. And this is important. And what I'm trying to show here is that in order to trade and to use any kind of analysis, you have to ask yourself the question, how do people actually trade this thing? With technical analysis, we have to use assumptions and beliefs, the beliefs that rising and falling markets are the same. I'm saying to you, don't come into a market using beliefs, find out how it actually works. Interestingly, looking at some of the studies, in particular studies on equities, they found that the performance of technical tools was very different for short trades than for long trades. I'd like to add a note that the overall performance was poor anyway, but there was a clear difference between the way that these tools and indicators worked on long trades and short trades. They performed far worse on short trades, i.e. when the market was falling. We're told all markets are the same. Technical analysts apply their tools across all markets, foreign exchange, stocks, bonds. It's one of the appeals of technical analysis to retail traders in particular, and to technical analysts. We can use it in all markets in the same way, because all markets are the same. That's what they tell us. But are markets the same? And again, we need to understand how markets work. Here I've got a simple table, foreign exchange versus equity. Let's discuss how they actually work. In foreign exchange, if you're buying the dollar, yen, euro, dollar, or trading those, there's no differences between buying those rates or selling those rates. With equities, if you want to short sell an equity, you need to be able to borrow the stock. That's a clear difference. Foreign exchange has a diverse range of participants, central banks, corporates who hedge various risks that they might have. There's mum and dad traders who are very small, and then there's big banks and some funds. Equity have a different type of investor or participants. They have long-term investors, quite a few mum and dads involved there, either directly or indirectly. They have funds who are mandated in many cases to hold equities, simply to buy them. But no, there's no central banks in equities. Corporate hedging is minimal, if anything. Corporates don't normally need to hedge equity. So again, different types of people playing it. With FX, if I asked how many of the market at any one time are long or short, it would be very difficult to know, particularly because there's hedges from corporates and that kind of activity. The numbers can vary. Sometimes it might be 50-50, sometimes maybe 70% of participants are long. There's no real way of knowing. With equities, we know that over 95% of equity participants only ever trade from the long side. That's very different. This is a market of people who are constantly bullish. They only ever buy. With FX, there's no cap to the market size, so to speak. The market is a huge market, and with derivatives and everything else, there's no way of knowing what amount of money is floating around the pond. With equity, we have a defined number of shares. There is a market cap. There is a free float. Sometimes within that, some of the market cap is already tied up. So what I'm saying is that these two types of markets are completely different. Sure, if you chart them, they look the same, but they're not the same. And these issues are exaggerated if you look at small cap stocks. Sometimes you can't short sell a small cap stock. Sometimes they have very small free float because the directors hold a lot of it. What does the chart tell us? Often not a lot. So they will look the same in a chart, but they're not. The mechanics of these two types of market are completely different. Therefore, I would say that the psychology of them must be different. Take this simple graph. If this was a graph of a currency, you could make certain assumptions. But they would be assumptions, and all assumptions are dangerous. But let's say this was a small cap stock, where there was no ability to short sell because there was no stock borrow. there's only a small free float as well. What would that mean for the context of this graph? It means a lot. It means that people who don't like this stock, who think it's overvalued and want to sell, can't. This stock can only represent the people that like it. And the people that don't like it, if they hold it, originally will sell to other people that like it. But that's a very different set of assumptions. An underlying assumption of technical analysis is that everything is in the price. So we'll just look at the price. Everything around us is in that price. Again, if we believe this is untrue, we should not use technical analysis. But for example, with a small cap stock with no ability to short sell, how can everything be in the price? The people that don't like it can't trade. In fact, for all equities, where over 95% of people only ever trade from the long side, how can everything be in the price? Traditionally, these people are overly bullish and they miss, and in some cases they don't care about bad news. If you're a big fund, superannuation or pension fund, you're mandated to hold stocks no matter what happens. Is technical analysis successful? Well, in the technical analysis and the active trader, I looked at dozens of studies, robust studies from institutions all around the world, and they found, in not just in general, but pretty much all of the decent studies found technical analysis to be unreliable and would lead to losses for most people who use it. In the previous presentation on chart patterns, I showed the Federal Reserve of New York. Their studies into Head and Shoulders pattern found it to be unreliable. An excellent study by Sullivan, Timmerman and White from the London School of Economics studied almost 8,000 technical tools and indicators on 100 years of data and found none to be profitable after fees. What these studies show is you will need very deep pockets and a lot of luck to survive as a technical trader. Of course, it doesn't mean that everyone will lose money. In large sample sizes of thousands of people, some just by chance will make money. It doesn't mean that they're good. And the law of survivorship bias means that those winners are the ones that you're going to see. They're the ones that will be glowing references for the courses. And the huge percentage of losers, they won't write books about how much they've lost. They won't give testimonials for the courses they've done, but they're still there. Since the publication of my book, there's been a really interesting new study which actually used real trading accounts. 5,500 trading accounts over 6 years, where traders had identified what type of trader they were, fundamental, technical, or other, which tended to be sort of instinct or other reasons. These two quotes are quotes from that study. We find that individual investors who use technical analysis and trade options frequently make poor portfolio decisions, resulting in dramatically lower returns than other investors. And the marginal cost associated with technical analysis is approximately 50 basis points of raw return per month. They found that in real trading accounts, the technical analysis traders were the worst. They suffered the largest losses, and it was significant. So in summary, I would say it's doubtful that technical analysis and charting, as used by most people, is a reliable study of market psychology. It's more likely to be a shortcut. The underlying assumptions behind what we're told, in my opinion, simply do not hold up to scrutiny. They're not how markets really work. And leading into that, studies into technical analysis have showed it to be unreliable.